Japan is the most important economic story nobody talks about. Here is a country with world-class technology, near zero unemployment, and one of the highest educated workforces on Earth. And for 30 years, it went nowhere. 3 decades of near-zero growth, 3 decades of falling prices, 3 decades of a central bank doing everything economists said it should, and watching it fail in slow motion. That would be interesting enough on its own. But here is why you actually need to understand this. What happened to Japan is not history. It is a preview. China is living Japan's 1990 right now. Germany has contracted for 2 consecutive years. South Korea's birth rate just hit the lowest number ever recorded for any country in human history. The economic trap that swallowed Japan is spreading, and the world is watching with the same confidence Japan's policymakers had in 1991, right before everything fell apart. By the end of this video, you will understand the exact mechanism that broke Japan's economy. You will understand why standard economic tools, interest rates, money printing, government spending, could not fix it. You will see why China is in more danger than most analysts admit. And you will walk away with a mental model for reading any country's long-term economic future that no mainstream financial media outlet will give you. Let's start at the peak. December 29, 1989. The Tokyo Stock Exchange closes at 38,915 points. Japanese real estate is so valuable that the grounds of the Imperial Palace in central Tokyo are estimated to be worth more than the entire state of California. Japanese corporations are buying Rockefeller Center in New York. Japanese banks are the largest in the world. The country feels, to everyone inside it and outside it, like the unstoppable economic force of the coming century. 35 years later, that same index finally, barely, recovered to those levels. 35 years. An entire generation. If you were a 30-year-old Japanese investor at the peak of that market, you were 65 before you broke even. And that is actually the optimistic version of the story, because the numbers underneath the index tell something far darker. Property prices in Tokyo's prime districts fell 70 to 80% from peak to trough. Not 30%, not 50%, 70 to 80%. Banks that had lent against those values were technically insolvent. Corporations that had borrowed against those assets were drowning in debt. And in 1990, Japan's policymakers looked at this and said, "Don't panic. We can manage this slowly." That decision, to manage it slowly, is the decision that cost Japan 30 years. To understand why, you need to understand a concept that most economics textbooks barely mention. It is called a balance sheet recession, and it is the key to everything. Normally, when a central bank cuts interest rates, businesses borrow more, invest more, hire more, and the economy grows. This is the standard model. It works most of the time. But there is one condition under which it completely stops working, and that condition is when the private sector is not trying to maximize profit. It is trying to minimize debt. Think about what happened to Japanese companies after 1990. They had borrowed enormous sums against assets that had just collapsed in value. A factory worth $100 million was suddenly worth $20 million. But the loan against it was still $100 million. The company was technically bankrupt. Not operationally. It could still sell products, pay wages, generate cash. But its balance sheet was destroyed. What does a rational company do in that situation? It does not borrow more, even at 0% interest. It takes every yen of profit and pays down debt. Survival first. Investment second. This is individually rational. It is collectively catastrophic. Because when every company in the economy does this simultaneously, something terrifying happens. Demand collapses. Not because people don't want things. Because the corporate sector has stopped spending. Government tax revenues fall. Unemployment creeps up. Consumers get nervous and start saving more. And now you have both the corporate sector and the household sector pulling money out of the economy at the same time. Richard Koo, the economist at Nomura Research Institute who first identified this mechanism, called it the Holy Grail of macroeconomics because it explains the one scenario in which all standard tools fail. And he argued that Japan was living proof. Cut rates to zero. Fail. Print money. Fail. The private sector is not borrowing because it does not want to borrow. It wants to survive. Here is the part that should genuinely unsettle you. The Bank of Japan cut rates to near zero in 1999. 25 years later, rates were still near zero. 2.5 decades of free money. And Japan's nominal GDP in 2023 was barely higher than it was in 1995. The medicine did not work because the diagnosis was wrong. But the balance sheet recession is only half the story. The other half is something no policymaker can print their way out of. Demographics. Japan's working age population, people aged 15 to 64, peaked in 1995. Since then, it has declined by over 11 million people. Think about what that means for an economy. 11 million fewer workers producing things. 11 million fewer consumers buying things. 11 million fewer taxpayers funding the government. And the projections say another 20 million will exit the working age cohort by 2050. An economy is, at its most fundamental level, people producing and people consuming. When you structurally reduce the number of people doing both, you structurally reduce the size of the economy. This is not a policy failure. This is arithmetic. Japan's total fertility rate today stands at 1.20. The replacement rate, the number needed to keep a population stable, is 2.1. Japan has been below replacement for decades. The population is not just aging, it is shrinking. And a shrinking population, all else equal, means a shrinking economy. The question is not whether it happens. The question is how fast and how badly. Now here is where the political economy layer gets truly important, because Japan knew all of this. Economists were writing about the demographic cliff in the 1980s. Think tanks were modeling the fiscal implications in the early 1990s. The policy response was always too little, too late, and too politically compromised to work. Why? Because Japan's political system was controlled, and still is largely controlled, by the Liberal Democratic Party, which had governed almost continuously since 1955. The LDP's survival depended on a web of relationships with Japan's largest corporate conglomerates, the keiretsu, those cross-shareholding networks of banks, manufacturers, and insurers that dominated Japanese capitalism. Allowing banks to honestly recognize their losses, write down bad loans, and let insolvent firms fail would have triggered a political earthquake. So they did not. Instead, Japanese banks kept lending to companies that could not survive on their own. Not because the loans made economic sense. Because letting those companies fail would force the banks to recognize losses they were hiding on their books. These companies became known as zombie firms, technically alive, economically dead, consuming credit that should have gone to productive businesses. Caballero, Hoshi, and Cassiop, three economists whose research became a landmark paper in the American Economic Review, found that zombie firms accounted for 12 to 15% of Japanese listed companies during the worst years. And the damage was not just that these firms were unproductive. They actively crowded out healthy firms. Why compete for credit when the bank is keeping your insolvent competitor on life support at below market rates? Creative destruction, the process by which failing businesses die and their resources flow to better ones, was switched off. Japan's economy became a museum of the 1980s, preserved in bureaucratic amber, unable to restructure, unable to innovate at scale, unable to let the market do what markets are supposed to do. And here is the final layer that locked Japan in. Once deflation, falling prices, became expected, consumer behavior changed in a way that made the problem self-fulfilling. Why buy a car today if it will be cheaper next year? Why invest in a factory if your output will sell for less in 5 years than it does today? Deflation is individually rational and collectively a death spiral. The Bank of Japan spent decades trying to break this psychology. It printed money. It bought government bonds. It eventually bought stocks. It held rates at zero. It introduced something called yield curve control, essentially setting a ceiling on government borrowing costs. And still, inflation remained near zero or negative for most of the period between 1999 and 2022. The expectation of deflation had become so deeply embedded that even the most aggressive monetary experiment in modern economic history could not dislodge it quickly. Your money sitting in a Japanese bank account, earning nothing, was actually earning something, because prices were falling. Doing nothing was rewarded, investment was punished, and the system locked itself into a low-growth, low-risk, low-return equilibrium that no policy lever could easily break. Now let's look at who is following the same path. China's real estate sector has been the engine of its economic miracle. At its peak, property and property-linked industries accounted for roughly 25 to 30% of Chinese GDP, once you include all upstream and downstream effects. Steel production, cement, furniture, appliances, construction employment. The entire economic ecosystem was wired to the belief that Chinese property prices would rise forever. Then Evergrande collapsed. Then Country Garden. Property prices in major Chinese cities have fallen 20 to 40% from peak in many markets. Chinese households hold approximately 70% of their wealth in real estate. Compare that to 35% in the United States. When those assets deflate, Chinese household balance sheets take a direct hit, and the behavioral response is exactly what Japan showed us. Stop borrowing, start saving, minimize debt, wait. Xi Jinping's government has responded with stimulus, infrastructure spending, rate cuts, easing of property purchase restrictions. And the results, so far, have been underwhelming, because the problem is not demand management. The problem is balance sheet repair. And that takes years, not quarters. But here is what makes China's situation potentially worse than Japan's. Japan's working age population peaked in 1995, 5 years after the bubble burst. China's working age population peaked in 2011. China is already in demographic decline, simultaneously with its balance sheet recession. Japan at least had demographic runway when the crisis hit. China does not. Chinese birth rates collapsed after decades of the one-child policy. The fertility rate today is approximately 1.09, lower than Japan's. A country of 1.4 billion people is structurally shrinking. The working age population decline will accelerate through the 2030s and 2040s. China may, as one demographer put it, get old before it gets rich. Now look at Germany, Europe's largest economy, the country that was supposed to anchor European stability and growth. Germany's GDP contracted in both 2023 and 2024. That makes it the only major G7 economy to shrink for 2 consecutive years. The industrial model that made Germany rich, cheap Russian energy, open Chinese export markets, high-value manufacturing, has been structurally disrupted. Energy costs are now structurally higher. Chinese competition in electric vehicles and machinery is intensifying. And Germany's workforce is aging rapidly, with a median age of 45.7, among the highest in Europe. This is Japanification in progress. Not the exact same mechanism. Germany's banks are not hiding zombie loans on the scale Japan did. But the combination of demographic headwinds, structural industrial disruption, and demand stagnation is producing the same output, near zero growth in the world's third largest economy. South Korea's numbers are the most alarming of all. A fertility rate of 0.72 in 2023. Think about that number. Not 1.2 like Japan, not 1.09 like China, 0.72. That is the lowest fertility rate ever recorded for any sovereign nation in human history. At that rate, South Korea's population will have within 2 generations without dramatic immigration. South Korea is showing us what comes after Japan. The acceleration, the intensification, the demographic math becoming so extreme that no economic policy can easily compensate. And now let's apply this framework somewhere completely different. Because the lesson of Japan is not just about aging rich countries. The lesson runs in both directions. Nigeria has a median age of 18, a fertility rate of 5.1, a population projected to exceed 400 million by 2050, making it one of the world's most populous nations. Nigeria will not face a shortage of workers. It faces the opposite challenge. The question is whether its economy can generate productive employment and productive investment fast enough to absorb an exploding working-age population. Here is the PhD-level insight. Japan's trap was too few workers with too much capital sitting idle. Nigeria's potential trap is too many workers with too little capital deployed productively. Both traps have the same root cause, a failure of productive investment. In Japan, the private sector destroyed investment by minimizing debt. In Nigeria, the risk is that institutional weakness, infrastructure deficits, currency instability, and capital flight prevent productive investment from arriving at scale. Demographics is not destiny. But demographics sets the parameters inside which policy must work. And ignoring demographic math, as Japan did, as China is doing now, as European policymakers are doing, is not optimism. It is denial with a 30-year price tag. So what are the 5 insights you should carry from this? First, monetary policy has a structural limit. When the private sector is repairing balance sheets, cutting interest rates to zero does not generate growth. It buys time. What actually works is direct fiscal stimulus, government spending to fill the demand gap that the private sector has vacated. Japan learned this too slowly. The global economics community acknowledged it too late. Second, deflation is harder to escape than inflation. Central banks have many tools to cool an overheating economy. They have far fewer tools to restart an economy where everyone rationally expects prices to fall. Once deflation expectations are embedded, they become self-fulfilling in a way that inflation expectations almost never do. This is why the Bank of Japan's recent, historic shift to positive interest rates in 2024 is so significant. It represents the first credible break in that psychology in a generation. Third, demographics is the variable that determines everything over long horizons. Not monetary policy, not technology, not government leadership. The fertility rate of a country, measured 25 years ago, is the most reliable predictor of its future economic capacity. Japan showed us this. China is confirming it. Any country with a fertility rate below 1.5 and no credible immigration strategy is already in slow-motion economic decline. Fourth, zombie firms are not a Japanese quirk. The IMF has identified zombie firm proliferation as a global phenomenon following both the 2008 financial crisis and the COVID-19 pandemic. Ultra-low interest rates extended everywhere, created the same incentive structure. Keep failing firms alive with cheap credit rather than let them restructure. The productive cost of this policy, globally, is still being counted. Fifth, the carry trade is the hidden transmission mechanism connecting Japan to everything. For decades, global investors borrowed cheaply in yen, rates near zero, and invested in higher-yielding assets in Australia, Brazil, the United States. This yen carry trade suppressed global yields and inflated global asset prices. When the Bank of Japan raised rates in July 2024, just to 0.25%, the carry trade partially unwound. The Nikkei fell 12% in a single day. Global equity markets convulsed. Japan's domestic monetary policy had become a load-bearing pillar of global financial stability. That is how embedded 30 years of near-zero rates had become. What happens next? 3 things to watch. Watch China's property market stabilization. If prices find a floor and household balance sheets stop deteriorating, China can avoid the worst-case Japan scenario. If prices continue falling and the deflationary psychology sets in at scale, which 1.4 billion people experiencing simultaneously, it will be the most significant economic event of the 2020s. Watch the Bank of Japan's rate normalization path. Every incremental rate increase from near zero carries carry trade unwind risk. Japan is trying to normalize 25 years of monetary policy emergency in real time, without triggering a global financial shock. It is an extraordinarily delicate operation, and the margin for error is narrow. Watch Germany's industrial policy response. The German government faces a structural choice between managed industrial decline and a genuine, expensive transformation of its manufacturing base toward green technology and higher value sectors. The political economy of that choice, who pays, who benefits, which workers and industries lose, will determine whether Germany pulls back from stagnation or deepens into it. Here is the closing model I want you to take from this. Every economy is a machine that converts population into production and production into prosperity. Japan showed us what happens when that machine runs in reverse. When the population shrinks, when debt suppresses investment, when deflation rewards inaction, when politics protects the incumbent over the productive, the machine slows. And it slows in ways that feel manageable year by year and devastating decade by decade. The world watched Japan for 30 years and treated it as an exception, a cultural quirk, a unique failure mode of a uniquely consensus-driven society. The data now says that was wrong. Japan was not an exception. Japan was a preview. The countries still calling it an exception are the ones that will learn the same lesson, just 30 years later. If this video changed how you see the global economy, subscribe. Because next time, we are going inside the institution that was supposed to prevent all of this, and we are going to show you exactly why it always arrives too late.